We're often being asked about flexible funds versus series funds. I wanted to give you a little bit more information and dive in a bit about what flexible versus series actually means and the pros and cons of really each. That they both have their time and place that it makes the most sense. But to start with, the series means that you're using a series LLC that divides different interests. That's like subsidiary LLCs, protecting one series, one asset from another one, versus a flexible fund, which is really a regular LLC that's broken up into classes. The big difference is the tax language, basically stating that one class will be taxed independent of any other class. All of it makes sense with the flexible funds. It allows for one K1 to go out, where with the series fund, every separate series gets its own tax return. Some pros of using the flexible fund is you can bring in investors to a general fund and then allowing them to pick and choose which assets they actually invest. It's a great strategy if you're issuing a bunch of debts like a real estate hard money loan. Let the investors pick and choose between them. Or you're doing single family homes or smaller transactions, doing more the flexible fund that you're doing smaller deals, limiting the expense per deal really does make a lot of sense. However, if you are targeting larger transactions, meaning you're doing multifamily or you're doing commercial or other larger real estate transactions, the protection that the series offers you is so very important. Now, this is where the concerns and the drastic difference of protection really comes into play. Let's pretend like you did a flexible fund as well as a series fund. And you bought a bunch of assets and there's a lawsuit. With the series LLC and the series funds, because each series is segmented one against the other, and under state law, everyone is treated from an asset protection perspective like its own LLC. That one lawsuit can only reach the assets of that one series. It can't affect any of the other ones. They're different. They're separated, giving you additional protection. Now, under the flexible fund, a creditor can reach every asset underneath that LLC. Potentially, all those assets are gone. There are some strategies to limit that risk for the flexible funds, namely having each class own a single purpose entity underneath this flexible fund. The problem is in a lot of states, one as an example, I'm sitting here right now, Texas tend to pierce the corporate veil, meaning they're reaching through the LLC and holding the owner responsible for whatever the harms that SPE, that single purpose entity, was there to protect. If that happens again, all of the assets are at risk, even if you do take those steps to try to protect. With the series LLC, it is written into the laws. There are processes, separate bookkeeping, but also separate tax returns. Each of these series is treated like its own company, so the risk of that is greatly reduced. So at the end of the day, these flexible funds, I actually think that they have their place for the smaller deals. It's truly a money-saving strategy, not necessarily on the setup. Generally, the series setup is the same. Creating separate series is about the same. But the big cost difference is with the series fund, there's separate tax returns, separate protections, separate processes for each of those assets, where with the flexible fund, you do absolutely get the benefit of only one K1 and the drawback of all assets at risk. If you have more questions about, hey, I'm thinking about doing this series fund, I'm thinking about doing this flexible fund, I'm looking to save money across the board no matter what, reach out. But the most important thing is make sure that you have experienced, competent attorneys that have been there and done that and seen the risks and seen the problems and knows how to keep you legal and out of trouble. So I hope you learned just a little bit about the flexible versus the series. At the end of the day, your ability to do multiple investments underneath one roof, saving some money, saving some time, both of those strategies work. Now, what's best for you and your investors?